Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. The 6-month moratorium period, which was from the 1st of March to the 31st of August, according to us, it was a sheer time pass. It was a waste of time. Nothing was done during this period in order to strengthen, support, and stabilize the cash flow and incomes of borrowers of businesses who, today, according to us, when the moratorium ends, are far worse off than what they were when the moratorium began on the 1st of March. This is confirmed by a recent survey of Care Ratings. Care Ratings says that in the first quarter of this financial year, which is the quarter ended 30th June, the revenues of listed firms fell by 25%. In the case of MSME enterprises, Care Rating says the revenues fell by 67% and their profits fell by 60%. In other words, in the first quarter of this financial year, incomes fell, revenues fell, cash flows shrank, and of course, savings of these entities got eroded. This continues in the second quarter also. With savings, cash flows, income of borrowers having been eroded, and no fiscal support having come from the government in order to support and revive them, now that the moratorium has ended and recovery is imminent, the borrowers have got only one of two options: either default or go in for a restructuring. A defaulting would certainly mean end of the enterprise, because at this time, where is an alternate fund source available to a defaulting borrower to repay a bank? It is restructuring which is needed. Restructuring would have meant that the COVID impact would have been factored in and additional time would have been given to the borrowers in order to repay their loans. The borrowers in deserving cases would also be given additional loans to ensure that their viable businesses survive, they don't go down. It all had to do to ensure that the impact of COVID on businesses was taken care of. In our opinion, restructuring of loans was the most logical step to take as soon as moratorium ended. After all, viable and eligible enterprises needed to be protected, they needed support, and therefore, once the moratorium ended, such entities should have immediately seamlessly got into restructuring such that there is no immediate pressure on them to pay their loans and they are able to resume their businesses. To us, it was very evident that after the moratorium ended, a restructuring should be in place seamlessly. But strangely, what is very evident to us, what was sheer common sense to us, did not appear to be so for the regulators, and there has been a delay in announcing the restructuring according to us. It was only on 7th of August that the Reserve Bank governor announced a one-time restructuring option for borrowers who were eligible. And eligibility was defined as primarily those entities which are standard assets, which do not have a default, which are not NP accounts as of 1st of March 2020 when the moratorium period began. He said that additional time of 2 years would be given to these entities to either repay their loans in an elongated manner or by way of a moratorium. He also mentioned that additional loans would come in deserving cases if the bankers thought so. And in order to decide under what parameters, terms and conditions and standard operating procedures restructuring of loans should be done, the RBI governor appointed a committee under KV Kamath. This committee was supposed to announce the parameters of restructuring on a sector basis, and it was also given the authority to vet restructuring proposals which exceeded 1,500 crores of loans. The RBI governor also said that restructuring or resolution by way of restructuring, as he said, would be decided by banks in each case by the 31st of December 2020, and it would be implemented within 90 days thereafter. The point to be noted here is that until and unless the recommendation of the Kamath committee did not reach the Reserve Bank of India, the RBI itself was in no position to announce the restructuring guidelines, and in case the Reserve Bank did not announce them, how would banks be able to implement them? It was with this fear in mind that the Finance Minister had announced that the Kamath committee recommendations will be in place by the 6th of September and that banks will be in a position to start implementing restructuring cases by the 15th of September. With these timelines in mind, yesterday the Kamath committee submitted its report to the Reserve Bank of India. Its report has come after due discussion with rating agencies, with various stakeholders, and after study of sector-wise financial reports, as they say. And based on that, the committee yesterday issued financial parameters for 26 sectors. Those sectors include the likes of real estate, construction, steel, cement, retail, which is wholesale and retail trade both, transportation of every sort, airlines, hospitality, etc. The surprising exclusions are NBFC, media, entertainment. But the committee says that wherever they have not given specific recommendations, the bankers must decide their own parameters on their own assessments. It further says that restructuring packages must be implemented in a bucket basis, and for that it defines three buckets. Those cases where the stress of COVID on the business and the borrower was mild, those where it was moderate, and those where it was extremely severe. In respect of mild and moderate stress, the committee says that restructuring packages must be implemented in a quick and simple manner. But in terms of those where it was a severe stress, it says that a comprehensive restructuring package will be needed to put in place. It then has laid out 5 mandatory financial parameters to be followed in every case of restructuring, and these are financial ratios that will have to be adhered to. Other ratios, other sectors not mentioned by the committee will have to be decided by the bankers on a case-to-case basis as they think fit. And these financial ratios are in respect of what we call liquidity, leverage and debt servicing to be maintained by the borrower. Ratios have been set, for example, in terms of current assets and liabilities, in respect of net worth, in respect of total borrowings, in respect of debt servicing capability. And borrowers will need to ensure that they comply with them latest by the 31st of March 2021. As we said, these recommendations have come after discussions, and the Reserve Bank of India immediately accepted them and issued its guidelines to be followed by the banks concerned. The RBI also extended the tenure of this committee to the 30th of June 2021. After all, whenever large cases of restructuring with loans exceeding 1500 crores are going to be recommended by the banks, it is this committee which is expected to vet them, and therefore the tenure got extended. The Kamath Committee report did come within time as the Finance Minister had promised, and the Reserve Bank expectedly, immediately accepted its recommendations. After all, time is of essence, as the committee says. Time is of essence because if restructuring guidelines are not put in place immediately, there is going to be large-scale default in the banking system, and the entire system will be destabilized all over again, and that certainly needs to be avoided. Now that restructuring is at our doorstep and the bankers are expected to commence their recommendations, let's examine what is the larger picture that comes out of this and what is going to be the ground reality that borrowers will face. The first ground reality that borrowers will face is when they go to their bankers seeking restructuring, the first response is going to be of reluctance and refusal. Bankers are going to be averse to giving restructuring in an easy manner, even though the committee says that for mild and moderate cases, restructuring must be quick and simple, but that will not happen. The first response of the bank very instinctively would be, you better continue paying your loans, and in case you need restructuring, we will see. In the meanwhile, do not have any default because you are not going to be eligible for restructuring. And with that threat, the borrowers are going to be compelled to pay. Restructuring decisions are going to be delayed. The second is going to be that in case your industry is not in the 26 sectors recommended by the committee, in that case, the chances are very bright that bankers might just not restructure your loans, saying that there is no clarity of how to go about it. The third picture which is very evident is the committee has come up with what we call financial ratios with a one-size-fit-all approach. That is being done on a sector-to-sector basis. But in every sector, every unit, every borrower, every entity tends to be a unique entity. There are differences in terms of size, there are differences geographically, there are differences in the nature of business, and you cannot have standard financial ratios to be adhered to by every borrower. Some kind of flexibility is needed, but the committee says that these are mandatory. And in case bankers are not given flexibility, the chances of cases being restructured are going to be very poor. We think that this one size fit all approach for financial parameters is not going to be easy to surmount for many borrowers. Further, when you look at the ratios, it is very clear that these ratios have been designed more in mind for healthy borrowers than for COVID afflicted stressed borrowers. Many borrowers are not going to be able to comply with these ratios. It is very evident that to comply with them, borrowers are going to be required to bring in additional promoter equity. And how many have such kind of equity at this point of time? We think that those ratios are rigid and too stringent and they need to be toned down. Otherwise, many are not going to be eligible for restructuring. Rigid ratios with no flexibility is not going to help the cause of restructuring. It will defeat the very purpose and defaults will be imminent on the large scale. We think some rethinking is needed there. Further, knowing the way banks work, delays in restructuring are inevitable. It is not going to happen as quick as the committee may want or as quick as the finance minister may promise us. Bankers continue to be risk averse. With such kind of mandatory parameters set by the committee, they are not going to be able to exercise any kind of flexibility. Decision making is bound to be slow, and in the meanwhile, borrowers are going to suffer. We think that the key drawback of the committee's recommendations is this one size fit all approach and no flexibility to the bankers, and that rigid ratios are not going to be good for restructuring. As we said, the moratorium exercise proved to be a time pass, and we hope that restructuring exercise does not prove to be a time pass, as we have seen in the earlier restructuring regimes of CDR, SDR, S4A and all those. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.
If you like this video, please share it, and we would love to hear your comments in the comments section down here. Also, please do like our Facebook page and follow us on Twitter to get minute-to-minute news updates. For more such shows and videos, subscribe to our YouTube channel.